Welcome to TheoTrade. This is Don Kaufman. It's December 13th, 2024. Just 30 minutes to go to the cash close here on this Friday afternoon. The S&Ps, for the most part, massively unchanged. Nevertheless, we are considerably lower on the week, specific to the S&P 500. Look, we're going to discuss a lot here on this weekend update. Breaking bad markets. I'm going to explain that and much more here right now. Let's get into it. So with the S&Ps, as I said, they're kind of massively unchanged right now, but look at the divergence again in the force. I mean, the NASDAQ still ripping to the upside, but you go down and you look very objectively at what I kind of term the usual suspects, right? Your Microsoft, it's down by about 0.5%. Apple's basically flat. Amazon down 0.6%. Google down 0.6%. Look at Meta getting smoked a little bit here, down just about 1.7%. Oh, Tesla, though, holding on to it right now, up 2.7%. Nvidia down 2.5%. Now, I'm going to stop right there for just a second because let's just say, for example, maybe Tesla kind of cancels out Nvidia, which it doesn't actually entirely do, but this trading session, people, belongs to Broadcom. Absolutely owned by Broadcom at this point, which is now officially in the $1 trillion club. As of today, you are looking at about a 26% move. I mean, step back from the, from just some of the price action in here and recognize, yeah, that's good for 200 and basically $50 billion of market cap added to Broadcom today. $250 billion. There's a lot of companies inside the S&P 500 that are just nowhere near that. In fact, most of the companies in the S&P 500 are nowhere near what Broadcom actually added today. And as I said, Broadcom kind of owns the NASDAQ. And that's exactly one of the things I want to talk about here is that, it seems like every day throughout the course of this week, the S&Ps, let's start with the S&Ps, okay, and the week. Every day this week, the S&Ps kind of, edged, if you will, just a little bit lower. Yeah, we had a big rip and bounce back, but they kind of edged lower. And the marketplace was ultimately saved by one or more of, the Magnificent Seven. Of course, now we obviously have Broadcom, which is not in the Magnificent Seven, but it's going to be all kinds of wrong, man, when we have to say like the Magnificent Eight. Nevertheless, it's like stick save time and time again. Like, this week, earlier on in the week, if you take a quick glance over at Microsoft, upper edge of the expected move, it definitely reversed yesterday. But the way I caught that reversal, I'll talk about that a little bit. Apple, still upper edge of the expected move. Amazon, need I say more? Google, one of the most stellar weeks, okay, in its history, period. One of the most stellar weeks in its history on the idea of quantum computing over here. But the reason I'm going through this right up front over here is because when I talk about, breaking bad markets, the markets themselves, okay, you're seeing a very consistent, okay, falling advanced decline line. And most of your major sectors continue to decline. So I'm actually going to bring you over, right, to like the advanced decline line. Like, look, this is the S&P 100. All right, 65 stocks down. It's actually better than most of the days over here. In fact, if you're more comfortable, you can pull up the S&P 500. In the S&P 500, you can see there's 350 products that are effectively down. So it's a little bit of a crapshoot out there. Again, depends on which sectors you're looking at. But the entire marketplace, I'm not telling you anything you probably do not already know. The entire marketplace right now is being held together by a handful of tech stocks, which, you can make the argument that's been 2024. And I would appreciate that argument. But the problem right now is other sectors, they're not even getting dragged up. They're simply defecting. And I was talking about that pretty extensively on last weekend's update. You look at the financials, like, okay, so look, this is, basically one of the biggest sectors out there, that's some pretty severe sell side activity. And you start looking at it on a percentage basis. This is a sector that was up 35, 36%. It's now basically up about 30%. So there's some sell side activity in there. All right. Do I need to go a little further? Absolutely. If you take a look at the energy sector, things are getting absolutely smoked. It was up 15%. It's now in corrective territory. And we can go on and on and on. And this is nothing, again, that I haven't pulled up before, but you're consistently seeing sell side activity in major sectors. But I've got a different one for you in here. Okay. I'm actually going to bring up SPX equal weight. So this is SPX EW. And if you've never pulled it up, it's SPX EW. And it's kind of a cool thing to see, because some people talk about, like the advanced decline line and or market breadth, right? So market breadth right now is absolutely terrible, right? So there is sell side activity. I'm showing you different sectors, but I figured I'd give you a little bit of a kind of a different take. So the SPX, this is an S&P 500 equal weight. What that basically means is like Apple, okay, is worth the same as Microsoft, is worth the same as Tesla, would be worth the same as Caterpillar. And if you actually have everything equal weighted, take a look at the consecutive number of down days in here. In fact, that right there, okay, is actually it's one of the records for the number of consecutive down days in the SPX in terms of equal weight. It's wild when you start to think about it that way. And I'm going to tell you right now, so you're like, oh yeah, but you know what, Don? The SPX is not equal weighted. Yeah? And take a look at the Dow. It's not far from it. So the Dow is seeing pretty consistent sell side activity. All right? We take a look at like the Russell. The Russell starting to feel a little bit of volatility in here. Right? Everywhere you look, but NASDAQ is kind of getting tagged to some degree. I mean, look, there's some smaller sectors and so forth, but I'm sure everybody's like, oh no, this one has a bid. Like somebody was bringing up, I was talking about this the other day, and somebody was bringing up XLY, and they're like, you don't understand, man. It's consumer discretionary. XLY is all Amazon and Tesla. So it's not really consumer discretionary. It's tech, more tech, and all tech, right? So I wanted you to see that because it is, okay, far more dangerous out there right now than maybe the S&P 500 and or the NASDAQ give it credit for. I'm not saying that we're going to just roll over and die over here, okay, but the market breadth is bad. Most of the sectors are actually off right now. And look, the Dow, okay, Dow, it's getting a little bit more serious. Again, we've all seen some sell side activity over here, but it's so interesting because this divergence just continues to kind of grow, and that's why I call it breaking bad. So it's breaking, in terms of sector rotations and so forth. Most of them are actually getting hammered. Keep that in mind next week, because people I've said this for the last couple of weeks. We ain't in the clubhouse yet. Like the year is not over. You get the Fed coming up, right? It's exactly what we're going to talk about next. PPI and inflation. Well, there's definitely something is on my mind over here, and that has to do with PPI, obviously, and inflation. So we start talking about PPI. Okay, for those of you that's purchasing manager index, and look, CPI, which is the consumer inflation, okay, came out. The CPI was kind of in line, but PPI came out and was extraordinarily hot. So I'm not going to sit here and preach to you, all right, about PPI. Look, it's one indicator. It's just one indicator. And right now for the Fed, let's just clear. This is the CME. It's a Fed watch tool. Okay, what it basically indicates is a 97% chance. I'm going to say that again. There is a 97% chance, okay, that the Fed is going to cut, right, by 25 basis points. So it's over and done with. I think the Fed has largely been kind of removed from this, which brings me exactly to my next point. So PPI comes in a little bit hot. I believe there's actually a return to inflation, but the Fed's still going to cut. Even with the Fed cutting, all right, there's one very, very important thing to recognize. Okay, the Fed right now doesn't necessarily have control and a handle on the 10-year. So the Fed cut, all right, bottom line, it's already priced in. Fed cuts already priced in. It's 97% probability. So, the Fed announcement, unless Jerome Powell comes out and says something shocking, and I don't think he's going to do that, given the fact there's a new administration coming in, okay, the guidance moving forward is critical. When I say the guidance moving forward, I mean, it's going to be more or less like, what's the indication of Fed cuts into 2025. That's all anybody cares about because next week is largely priced in. But at the exact same time, this is the 10-year, and the 10-year right now, once again, people's trading 4.4%. I want you to think about the week that we're going into. Okay, basically, it's the last full trading week of the year. Like, okay, there's going to be Christmas, there's going to be New Year's, but this is it, people. This is the last full trading week of the year. Interest rates are actually priming higher, not lower. I don't care if the Fed cuts. Apparently, neither does marketplace because they see the exact same thing I do. Inflation ain't dead. Right? The US dollar is rocking to the upside over here. Bonds are seeing sell side activity. Inflation is clearly not dead. I think you could actually see a breakout of the TNX, literally a breakout of the TNX above 4.5%. And the reason that I'm calling this breaking bad markets, just think about this, because coming into the Fed announcement, which of course is, again, it's coming up on the 18th, right? So coming into this Fed announcement, I could really see these this 10-year creeping right up very, very close, very quietly close to that 4.5%. Fed comes out, we soar above 4.5%. You soar above 4.5%, and that marketplace may smoke big tech. The dangerous, dangerous little proposition over here. Why? Because you already have so many other sectors down. Even if the other sectors were to rally back, like think about this, the other sectors can rally back. Big tech starts to break and you're going to have problems. And big tech, okay, right now, it's fearless to everything but, okay, this bond market. Keep it in mind for next week because I think that's going to be the key to it. Another key to that, there's a huge, okay, triple witch coming up. Triple witching December expirations coming up. And I say it's absolutely huge. It's a massive OpX. Okay, OpX means option expiration. That is specific here to the SPX, the mother of all products. There's obviously an AM settlement and a PM settlement. It's actually going to be one of the largest OpXs. We're talking, probably between 4 and 5 trillion. It's difficult to zero in specifically on that until early next week, but you very well are looking at one of the largest option expirations in history of markets coming in here. So with that being said, you got to realize that OpX is going to move some capital, no question about it. Moreover, when you hit that option expiration, it kind of can really shake the marketplace loose to some degree. So it's considerations. We're also rolling forward in the futures contract. Okay, for those of you not aware of this, right now we're still trading the December futures contract, but the roll, okay, that roll is in full swing. That means we're actually moving from Dec to March. That doesn't mean anything. The volume though is unreadable inside of the S&P futures contracts while the roll is going on. As I said, like that doesn't really mean anything. Oh, we're rolling like. But the option expiration is everything. And the reason we call it a triple witch, you have the futures, okay? You have the, the index options and equities all basically going off to expiration. But the SPX being the mother of all products, this is a really big OpX for it, okay? Keep it in mind. It's a really, really big option expiration. It's got a lot of positioning in and around that one. In fact, there's added volatility, which we're going to get to here in just a moment for that. Okay, let's switch gears entirely on you. Signs of excess are still everywhere. I've been talking about this also extensively. When I say signs of excess, if you guys look, everywhere you look, you're seeing this marketplace be propped up, okay, by, if you will, signs of excess. You look at stuff like Tesla, okay, nothing less than phenomenal over here. I think it's very difficult to make any fundamental arguments, nor do you have to. You don't have to make fundamental arguments for this. You don't have to make an argument for the fact that we now have $260 billion of market cap added to Broadcom, but ultimately just some wild moves. Google, okay, Google obviously having an incredible week. I mean, just to break this down a little bit here, Google basically started the week up 26%. It's ending the week up basically 38%. Okay. As I said, when I say signs of excess, what it looks like, okay, to me at this point is we are selling everything that's very close to like its lows, meaning like selling 52-week lows. You don't have to look that far to see this. Okay. If you look at like the energy sector, okay, things are being sold in the energy sector, okay, and that capital is being forced, okay, into some of this mega market capitalization, all right? Anything, okay, that the performance is questionable is getting smoked out there right now, like literally, like especially when you start looking at like major sectors in here, like materials and so forth. Holy crap! And this thing was trading 95 a few days ago. Okay, this is one of the nastiest moves we've actually seen. Down the list, like industrials, they're smoking things. So the home builders. Okay, again, we are selling what's ugly and buying what's pretty. The only problem is there's less and less of what's pretty. So there's this incredible concentration into a smaller number of products, and it's an ever smaller number of products at this point. Here's something really interesting. You recognize that NVIDIA is getting absolutely no love, that the rally that we're seeing inside of like NASDAQ right now, it's not included NVIDIA. In fact, NVIDIA is breaking through the lower edge of its expected move. Better keep an eye on that as well, right? Again, that's why I'm kind of calling it Breaking Bad over here. It's there are some really ugly signs in this marketplace. And when I say that there's signs of excess everywhere, again, that excess is selling what's incredibly weak, buying and forcing capital into strength. But it's also in places like, okay, the crypto markets once again, okay, completely wild when you have things called like, fart coin that are $500 million market caps. We were talking about Peanut the Squirrel a couple of weeks ago, still at $1.5 billion market caps. Okay, all these meme coins, it's wild. There's a lot of excess capital, okay, chasing, okay, decreasing areas of returns. And it is, again, cannot stress enough, it's a dangerous time when you see this, right? So it's everybody shifting capital, looking for returns, and really throwing risk to the wayside. All right, let's also discuss a little bit about this week's trades before we get into the SPX. So I've had a couple of trades throughout the course of this week. In fact, had a really good week. Lows, we shorted lows with an in-out spread. We're out for a 30% gain. If you're kind of curious here what this looks like and what this kind of amounts to. I'm in here for 210. I'm out for 273. Okay, that was basically a 24-hour trade. Taking a quick glance over at Microsoft. Okay, I did a lot in Microsoft, so I got to isolate this to about 2 days. Okay, but inside of Microsoft. Okay, in Microsoft, this is quick scalp. Bought in for 204, closed for 365. All right. Then let's show the mother of all trades. This one was today. So today, if you were live inside of the chat room with me here at TheoTrade this morning, I put on an SPX butterfly. That SPX butterfly I paid 55 cents for. I don't mind saying I only did a one lot. Took a shot in here, and I love my butterflies. This butterfly was all about the expected move. Okay, so figured we'd take a shot for the lower expected move inside of the SPX, and did exactly that. And just make sure everybody actually sees this on the screen over here. This is the best one I've had thus far this year, but we took 55 cents, and 3 hours later, okay, turned it into $5. It's a 810% return in that time frame. So it's winner chicken dinner once again with these SPX butterflies over here. Again, you can see us coming right up to the lower edge of that expected move, swing and a miss, but we actually hit it for a full $5 credit on that one. It was awesome. Last but definitely not least, I entered into a bearish trade on Boeing. Boeing has effectively been straight up. I don't need a massive pullback over here. Okay. Next 35 days, just need a decent pullback, okay, under the 165 level, and that one will actually pay us. This is an in-out spread. Actually did a lot more trades than that throughout the course of this week, but I'm just saving, a couple for you here. There's a few more trades I'll be entering into early next week, prior to, of course, the Fed announcement. All right, last but definitely not least, we always talk about the SPX. Right? Why? As I said, it's the mother of all products. So the SPX will, in fact, finish this week lower. And by the way, say what you will about it. The one thing I loved about this week, okay, it's two-sided trade, people. I don't ask for much. But I do ask for two-sided trade. And two-sided trade, there's buyers and there's sellers. I mean, this, kind of vertical move the last 3 weeks, that's tough because it's hard to, get entry and so forth. As soon as we start getting some of this two-sided trade, it's things play out. extraordinarily well. So we hit the lower edge of the expected move, and I do want to show this once again on the week. We hit the lower edge of the expected move literally, okay, on Tuesday. We almost tested into it again today. The SPX will finish marginally lower this week. We only had, though, it's about a $61.81 expected move. So that was the movement priced in for the entire week. I got to be frank with you. I'm surprised we actually stayed inside the expected move. Very surprised we stayed. I even said last weekend's update, I was like, I would actually bet we would move outside that expected move. Now, this is all past tense. What are we looking at next week? Okay. What are we looking at next week? Well, 7 days out. Right now, and again, the market's not closed yet. It closes in a few minutes, but we take the SPX expected move 15 minutes, people, 15 minutes after the cash close, okay, is when we actually measure this, when everything kind of settles out. Right now, the expected move is $75. So it is, okay, a significant increase from a basically $2 move into about a $76 move. So again, you're coming off of a week where you had about $62 a move priced in. Now you're actually going to come into a week that's roughly, okay, $76. So it's a bit more of an expansive move that is going to be anticipated in here. And be very forthright in saying, okay, hands and feet inside of the vehicle. You have enough, okay, to really start to move this marketplace. And I cannot stress that enough. Again, I want to reiterate that you've got enough to really start to move this marketplace. Yeah, we've got some economic data coming out. But you do have the Fed, okay? Again, I don't think that the Fed is, but largely priced into the marketplace. It's the expiration, though, and the movement of capital. It's going to be huge, absolutely huge throughout the course of this week. The amount of capital actually changing hands into, of course, the last real trading week of the year. With that, again, breaking bad markets. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.